startups from one place. CNBC.com/technology.
We're back on the floor for the closing countdown. Major averages, muted losses today. The Dow Jones Industrials were off about 28 to 30 points or so within the last hour or so. But some individual stock stories that were of note today. Certainly Tiffany is one. The CEO unexpectedly leaving after a little more than a year on the job. So that stock was under pressure today. And then Disney, speaking of CEOs, a report by the Wall Street Journal that Bob Iger may be sticking around a little bit longer than expected. He's supposed to leave in 18 months. So those prospects are giving a little bit of a lift to that stock. And speaking of media stocks, 20th Century Fox reports after the bell. We're going to be watching those closely as well. Oh, look who I found.
There you go.
It's Bob Pisani over here.
Just walking by. I thought I'd say hello.
So now we feel like we're at this pause mode again, right? We had this big lift after the election, then a little bit of a pause. Then towards the end of last week, that push higher when the president met with that room full of CEOs. Some of the financials started to take off again. And here we find ourselves kind of wondering maybe where we are in terms of where the agenda is going to be and how fast it's going to get.
You'll notice every time the president meets with auto executives and says, let's do something, or he signs an executive order for a new pipeline, the market does something. When he stops doing that or changes the conversation and talks about Obamacare, which is perceived to be a quagmire by the markets, don't stop doing anything and just sort of drift. And here we are again. Now, we're not in any danger. Remember, the markets are essentially at new highs. But I'll tell you this. If we start moving down towards 2,000, we move down 2,200, for example. We move down another 90 points in the S&P, close to where we were on November 8th election. He's going to notice that. And that's the risk to the markets right now, that we move down and he starts trying to change.
Away, though, right?
It's a long ways
almost
away.
300
I don't
points.
think he's going to, listen, he watches the markets. I don't think he's going to be particularly concerned until we get closer to where we were in the November. Remember, his big claim, the markets are doing great since I've been in power.
They all said the market's not going down.
That's right. That's a big help. One other thing I want to make, I don't normally talk a lot about Europe. I get a lot of calls this morning about what's going on in Europe. Did you see Germany closed at a new low for the year? Despite the fact that we had great economic data, the European PMI numbers were great overall. They are worried. It's not the economy. It's getting better. They're worried about populist politics there. They're worried about Marine Le Pen potentially winning. And they're not laughing at the idea when she says, I want to take France out of the euro.
Did you say Le Pen because I dropped my pen on the floor at the same time?
That was a momentary thing, but that's how well coordinated we are. We work so well together.
I don't know if people saw that or not, so I figured I'd call it out just in case they did. Do you think people are nervous about the timing of some of the initiatives from the president that they've been banking on? Tax reform and things like that. The president says over the weekend in the Super Bowl interview, hey, I'd like to get it done quick, but it could be pushed into
the president's getting educated, like everyone else, about this. Even over the weekend, he simply implied that Obamacare was not going to be repealed immediately. He's on a learning curve right now, and I think everyone is now starting to realize that much of what he's talking about is a 2018 event, not a 2017 event, particularly on anything related to tax.
Bob, good stuff. You're watching the bells here at the NYSE. Brendan Bryan and company at the NASDAQ Carver Bank Corp. Kelly picks up the second hour of the bell right about now.
Welcome to the closing bell, everybody. I'm Kelly Evans. Here's how we're finishing up the first trading day of the week on Wall Street. The Dow dropping 18 points, so we moderated our declines there just into the close. In fact, the Nasdaq almost turned positive. Both the Dow and the Nasdaq down less than 1/10 of 1% today. S&P 500, though, the broad index did fall about 0.2%. 2292, a drop of about 5 points on the bell there for the broad market. The Russell 2000, again, the underperformer. That's been a theme of late, dropping about 0.8% today. 1366 is your level there. And as you can see, the S&P does snap a 3-day win streak with the closes today. A Washington Post piece this weekend called President Trump the Chris Paul of politics. What does the NBA star think about that comparison? The LA Clippers player will be with us live later in the show to talk about that and the new investment fund he is working with. Stay tuned. But joining me today first, CNBC senior markets commentator and pro columnist Michael Santoli, Rebecca Patterson from Bessemer Trust, and Dennis Berman from the Wall Street Journal. Thanks, everybody, for being here. Mike, what do you think about this market? It's kind of quiet on the surface, but I thought Bob's comments just now were interesting, too, about the concerns that are building in Europe.
Yeah, without a doubt, there are concerns building in Europe. And, you know, the global markets have actually been right along with the U.S. markets in rallying here. So I think that's one thing to keep in mind when we talk about the Trump rally or the Trump trades. It's been a global upturn in economic activity and markets. So I do think you're starting to see a little bit of unease seep into those markets. You're also seeing gold rally a little bit. It's hard to know, up 7 or 8% year to date, if that's something that's trying to tell us a little something about the source of volatility elsewhere in the markets. But I do think this market does nothing except grudgingly right now. It's been stuck in this range. Small caps underperform, bond yields come down, so the big caps can't really move. But what happens? Those old growth stocks, the Nasdaq, as you mentioned, almost got positive. And I'm to see things like medical device companies and the other big Nasdaq stocks are finding to be, getting bids.
Where do you see the opportunities, Rebecca?
You know, I think it's going to be a year of tango. We go 2 steps, 1 step back. So I think Mike's right. The economic data is good and improving, and that and decent corporate earnings. Those are the fundamentals keeping us going higher. There's so much focus on policy right now, to date on the U.S. and now I think increasingly on Europe. We might get a Chinese little uptick in focus as well, and that's going to keep people on edge. We still think the equity market ends higher this year, but it's going to be a choppy year.
It's funny you mentioned China, Dennis. The data there overnight was, it weakened, maybe wasn't the biggest deal in the world. The export numbers were better. By the way, one of the things that's kind of happening beneath the surface as well, massive corporate debt issuance, investment grade, the big blue chip companies, you name it. Is that a sign of health fundamentally in these markets?
I think you have to say more or less that is, Kelly. Those bond yields are coming down. They were correlated for a large part of the beginning of the year, where the stock market was going up and the yields themselves were going up too as people sold off bonds. So look, if I'm a corporate and I can still issue debt at these really low rates, I'm going to do it. What's really interesting, though, is if there is a repatriation scheme that we might see for corporates, if we look at, say, Google or IBM, huge cash balances offshore. Why are they issuing debt now, perhaps when they could sort of use that same capacity going in the future? I don't know the answer to that, but I think you have to say corporate debt issuance right now, pretty much a sign of health.
Because the flip side of it, and I mentioned this, but global net equity supply turned negative last year